Welcome to my channel. Viewers, this is my last video on Bill of Exchange series. Hope you find it useful. Do not forget to click subscribe if you want immediate alerts when I post a new video. Also, please like and share this video. I'm going to cover 5 scenarios in this video. Scenario 1. Bill normally matures or dishonors. Scenario 2. Bill is sent for collection. Scenario 3. Bill is discounted. Scenario 4. Bill is endorsed. Scenario 5. Bill is renewed. And Scenario 6. Bill gets retired. Let us look at our first scenario. Scenario 1. Bill either matures or dishonors. This is a scenario where both the parties perform their part of the transaction and the bill matures on its maturity date, or if the drawee fails to honor his obligation of making payment to the drawer or the purchaser, the bill gets dishonored. Let us see what entries will be made in the books of both the seller and the purchaser. But before that, let us look at the format of our journal. The first column is the sequential number of the journal entries. The second column, namely transaction, is to write a brief description of the underlying transaction. The next column is for actual entries in the books of drawer or the seller. And the last column is for actual entries in the books of drawee or the purchaser, also called the acceptor of the bill. Do not forget, this is a transaction about sale and purchase of goods on credit. Let us refresh our memory about the principles of debiting and crediting an account. Increase in assets, losses, and expenses is always a debit and vice versa. Similarly, an increase in liabilities, revenue, gains, and capital or equity is always a credit and vice versa. Let us make entries. For the drawer or the seller, it is a sales on credit. As we know, sales is revenue, therefore, an increase in sales is credited. For the drawee or the purchaser, it is a purchase, which is by nature an expense or a current asset called inventory. Therefore, an increase in expense or asset is a debit. So we will debit purchases. These entries are still incomplete as one part of the entry is missing. In the drawer's books, apart from increasing sales, he is increasing his debtors or receivables for the money he has to receive from the drawee or the purchaser. Debtors or receivables are current assets. Therefore, an increase in asset is a debit. Similarly, for the drawee or the purchaser, it is just the opposite. He has a liability to settle this amount for the goods he purchased. Therefore, it is an increase in his liabilities. An increase in liabilities is a credit. Now, both the parties agree to enter into a bill of exchange arrangement to formalize and document the sale and purchase made on credit. The seller or the drawer writes or draws a bill on the purchaser or the drawee who accepts it and returns it back to the drawer. The seller or the drawer will now decrease one asset, namely debtors, and increase another asset, namely bills receivable, to simply replace debtors with bills receivable. We know an increase in an asset is a debit and a decrease in an asset is a credit. The purchaser or the drawee will reverse one liability, namely creditors, made at 1.1 above, and replace it with another liability, namely bills payable. Again, remember, an increase in liabilities is always a credit and a decrease in liabilities is always a debit. Now comes the bill's maturity date, and the drawee makes payment to the drawer. The drawer debits cash or bank for the incoming cash, which is an increase in assets, and credits bills receivable, which now gets settled, hence it's a decrease in assets. The drawee debits bills payable, which is a decrease in liability, and credits cash or bank, which is a decrease in asset. Let us suppose the drawee is unable to meet his payment obligation on the maturity date. This means point number 1.3 did not take place and the bill got dishonored. We will now make entries for dishonor of the bill. The impact of the dishonor is such that as the bill never existed, and we simply reverse the entries made at 1.2 above. Similarly, we will undo the entry made at 1.2 above in the drawings books as well. After passing the dishonor bill entries, the original position of both the parties for credit sale and purchase has been restored as bill of exchange never existed. This mirrors the situation recorded in entry number 1.1. In the case of dishonor of a bill, the drawer may get the bill noted and pay noted charges. Noting charges are the fees paid to the notary public for recording the fact of dishonored bill. When a bill is presented for payment and the acceptor fails to make the payment, the bill gets dishonored. In order to keep legal proof of such dishonor, the bill gets noted by the notary public, who is approved by the government. The drawer will recover noting charges from the drawee. Therefore, he will record drawee as his debtor, and since he himself is paying notary fees, his current asset, cash or bank, is being decreased. So he will credit cash or bank. The drawee is liable to pay or reimburse noting charges to the drawer. It is an expense for him, so he will debit his expense, namely noting charges. Since he is not paying these charges immediately, so he will record it as liability, namely creditor, and settle it in future. Scenario 2. Bill sent for collection. If a business has numerous bills he got from various debtors, he may send these bills to his banker for collection purposes. This is not discounting of a bill of exchange. The bill is sent for safety and collection purposes. The bank keeps the bill in its custody till the due date, and on the due date, the bank will present the bill to the acceptor. After collecting the amount, the bank transfers the amount to the account of its customer by giving credit to his account. The bank charges some nominal fee from the customer for services he rendered. In all our scenarios, the first two entries and the last entry about noting charges will remain the same. Only the entries in between will change, showing difference in each scenario. Our current scenario is when a bill is sent for collection. In drawers books, when a bill is sent for collection, the asset, namely bills receivable, get replaced with another asset, namely bills sent for collection. There will be no entry in the books of drawee. On the maturity date, the bill gets collected, so the asset, namely bills sent for collection, is reversed by crediting it, and cash or bank asset being increased is debited. In drawee's books, settlement of the bill means bringing his bills payable liability to zero by debiting it and decreasing his cash or bank asset by crediting it. If the drawee fails to make payment on the maturity date, the bill gets dishonored. This means bill no more exists and the entries made at 1.2 become redundant. The drawer will restore its original position as at 1.1 by debiting debtors or drawee account and by crediting bills sent for collection to bring it to zero. Similarly, the drawee will simply reverse the entry made at 1.2 above. Scenario 3. Discounting of a bill. Discounting of the bill refers to the encashment of the bill before the date of its maturity. The bank deducts its charges from the bill. The bank makes the payment of the bill after deducting some interest called a discount in this case. Again, our first two and the last entries remain the same. The drawer, when gets the bill discounted, debits cash or bank for incoming cash from the bank, debits the expense called discount, and credits bills receivable. The drawee makes no entry on discounting of the bill. On the maturity date, the drawer will make no entry because he already received cash by discounting the bill from the bank. but drawee has to make payment to the bank on the maturity date. So the drawee will make a usual entry by debiting bill payable and by crediting bank. If a discounted bill becomes dishonored, then the drawer will have to make payment to his bank for the cash he already received through the discounting process. He will debit the debtor or drawee account because he still has to receive this money from him and credit cash or bank for the payment made to the bank. The drawee will simply reverse the entry made at 1.2 above. Scenario 4. Endorsement of bill. Endorsement of the bill implies the procedure by which the maker or holder of bill transfers the title of the bill in assistance of his or her creditors. The individual transferring the title is called endorser, and the individual to whom the bill is exchanged called endorsee. The endorser in our case is the drawer. On endorsement, the drawer debits his creditor in whose favor he is endorsing the bill. This means he owed this money to his creditor XYZ. Instead of paying him cash, he endorses this bill in favor of his creditor XYZ so that he can collect cash when the drawee settles the bill on the maturity date. Since this results in decrease in his liability towards his creditor XYZ, the drawer will debit creditor XYZ and credit bills receivable. Drawee will make no entry. On the maturity date, drawer will make no entry because he exchanged his payables to XYZ with the receivables from the drawee. However, the drawee will make a usual entry by debiting bills payable and by crediting bank or cash. If the drawee fails to make payment on the maturity date, the drawer restores his payables to XYZ by crediting creditors XYZ and restores his receivables from the drawee by debiting debtors or drawee account. The drawee makes usual reversal entry of 1.2 above. In terms of noting charges, if the endorsee paid the charges, then the drawer has to receive these charges from the drawee and make payment to his endorsee XYZ by debiting debtor or drawee and by crediting creditor XYZ, who is the endorsee of this bill. Scenario 5. Renewal of a bill. When the acceptor of the bill approaches the drawer with a request for an extension of time for payment, the old bill is cancelled and the fresh bill with new terms of payment is drawn and duly accepted and delivered. This is called the renewal of the bill. The drawer and the drawee both make cancellation entries for the entries made at the time of issuance of the old bill. Effectively means cancellation of the old bill. The cancellation entries are just the reversal of the entries made in 1.2 above. The drawer will extend the period on an interest amount for which he will debit debtor or drawee and credit interest. Since interest received by the drawer is revenue for him, he will credit it. Similarly, for the drawee, interest is an expense, so he will debit it and credit creditors or drawer for the interest payable as liability. Then, an entry will be made for the new bill both in drawer and drawee's books, similar to the entries made at 1.2 above. Scenario 6. Retirement of a bill. When the drawee of the bill has funds at his disposal and makes a request to the drawer or holder to accept the payment of the bill before its maturity with some discount or rebate, and if the holder agrees to do so, it is called the retirement of a bill of exchange. For the drawer, the discount or rebate is an expense because he is receiving less cash than the amount for which the goods were sold and a bill of exchange was drawn. He will credit bills receivable to bring it to zero, debit rebate or discount expense, and debit cash or bank for incoming cash amount. On the other hand, for the drawee, the discount or rebate is revenue, so he will debit bills payable to bring its balance to zero, credit rebate or discount income, and credit bank or cash for the cash outgoing amount. This brings us to the end of this video. Hope you found it useful. Thank you for watching.